And welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp. It's great to have you with us this morning, a Thursday morning, not our usual morning, so we appreciate you being here, but it's before the holiday. The jobs numbers are out. They aren't going to analyze them themselves. So we're going to be doing that. In fact, Camelia Kuhnen of the Institute and the UNC Kenan-Flagler Business School is going to be with us in just a moment, doing the heavy lifting on that and some other topics that she's going to address as well. In addition to that, she will be taking your questions after she's done with her presentation. You can submit those at any time during the briefing by using the Q&A function at the bottom of your screen. It's usually behind the More button with 3 dots on it, so keep an eye out for that. That's the same place you can find closed captioning. You can turn on closed captioning for the briefing if you'd like by hitting that button while you're down there in the More section of Zoom. If you are with the media and asking us a question, please include your organization so we can prioritize your question and make sure that it gets answered. If you're with us by phone today and you have a question for Cami, please email it to me. I'm at rob_knapp@kenan-flagler.unc.edu. I will keep a lookout for those. We're going to try and go about 30 minutes, so 9:30. Have a lot to talk about, so I'll go ahead and get us going. Want to introduce Camelia Kuhnen, who's here to talk to us about the report this morning. And she is research director at the Kenan Institute, as well as a professor at UNC Kenan-Flagler Business School.
Good morning, everybody. Hi, Rob. Welcome, everybody, to this press briefing. We have a lot to cover today. It's been an interesting jobs report, so bear with me here as I walk you through many, many numbers. All right, so as you can see from the title of the briefing, we will talk a little bit about this idea of Vibecession that's been going around and when it might end. I'm sure you've heard this term, and it's basically talking about the disconnect between what we've been measuring in consumer attitudes, surveys, consumer confidence, consumer sentiment, about how people feel about the American economy, and the the numbers that are coming out about jobs, about the unemployment rate, and so forth. So there's been this disconnect, and that people in surveys have looked somewhat pessimistic, and the numbers have looked in the past few months relatively good. So are people mistaken in their assessments of the economy? What's going on, and when will this disconnect end? So I'll try to touch on these issues while also discussing today's new numbers. So we were relatively optimistic. The consensus about the change in non-farm payrolls for June was an increase of 125,000. Would have been the 4th month in a row of increase in non-farm payrolls above 100,000, which would have indicated a solid labor market from the point of view of, again, just counting jobs. Unfortunately, the number that came out is much lower than expectations, only 55,000. And that, if you wish, bad news, it may be counteracted a little bit by the slightly lower unemployment number that we are seeing. We were expecting to see an unemployment rate of 4.3%. It's 4.2% now. So again, from the distance, if you wish, that seems like good news. The unemployment rate has dropped. Unfortunately, the main driver of this slight drop in the unemployment rate is actually that a lot of people or some people have left the labor force. And so we will not count them for the purpose of the unemployment rate. And I'll talk more about the labor force participation rate in a few slides, but the bottom line is that we're seeing some categories of people leaving the labor force, and that is not a good thing for economic growth. And this, if you see on the slide here, the overall labor force participation rate across all the demographics, has dropped this month to 61.5%. Last month it was 61.8%. Before that, it was above. Earlier in 2026 was above 62%. It sort of had been sort of stable there for a while, but we're seeing this tick down in the labor force participation rate, which is not really a very good thing. So we'll investigate this a little bit more. In terms of wage growth, the average hourly earnings month on month have increased as expected about 0.3%. This is sort of a steady rate we've seen, which actually is, while nice and steady, you'll see in a bit, it's not quite compensating people for the change in the rate of inflation. Inflation has actually ticked up to so that inflation rate is above wage growth rates. So if you're a consumer, in the past few months, you've not really in real terms been better off if you looked at your wages. So overall, this particular report is not a really good one. If we were questioning whether people were unduly pessimistic about the macroeconomy as shown by survey data, it may be that people actually understood better than the forecasters what's going on, meaning the labor market is not quite as strong as the previous few months reports had indicated. And in fact, today we also learned that we revised down the non-farm payrolls numbers for May and for April by a total of about 74,000 jobs, which is about a 20% decline, right? So we were too optimistic in the initial readings of these numbers about what was really happening in terms of how many jobs we've added in April and May. So we have those the downward revisions for those 2 months. We have the low number for June. The picture is not exactly a happy one. And another surprise that came in today's report was that if you look at numbers for leisure and hospitality, they are even seasonally adjusted. They are relatively low, surprisingly low, especially given that we have the World Cup going on these days. And so a lot of economists are expected to see a bump from the World Cup, in line with what we saw back in 1996 because of the Atlanta Olympics. There, clear you saw a bump in jobs, but at least in the June data, we don't see this bump in leisure and hospitality. So not a really good report. Again, it might help us understand why in surveys, consumers and U.S. households in general report pessimism that was a little bit hard to understand in light of the numbers reported by various bureaus in the previous few months. All right, so in this picture you see the changes in non-farm payrolls over time. We were expecting a much better number here for June to continue this wonderful trend of high additions to payrolls earlier in the year, but that's not happening. So that's a little concerning. In terms of wage growth, it is below the inflation rate. So in this picture, the orange line tells you the inflation rate. The blue line is the rate of growth of wages. This, you can think of it as sort of a silver lining, because if wages grow at a lower rate than inflation, while it means that consumers can't, in real terms, are not better off, it also means that there will be less pressure on the rate of inflation. And so if we were the Fed, maybe this is a bit of good news. You're not as concerned about inflation as you might have otherwise. We'll talk more about the Fed in a few minutes now. The labor force participation rate, as I said, is a concern. That sort of the bad news that goes kind of counteracts the good news that you see in this figure, which is about the rate of unemployment that has ticked down to 4.2%. It is relatively low, but it's not a good thing to have a low rate of unemployment if you don't have a lot of people who actually wish to be employed. So the labor force participation rate you see in recent months has really been going down relative to the more stable level we've seen um, a couple of years after COVID. So that is not a good thing. That will impede economic growth. And we see a decline in participation among people who are prime age, both men and women. You see this tick down. Maybe that will reverse. You see also a tick down in terms of participation of younger people, 16 to 24. And if you look at those who are 55 and years old and older than that, clearly a decline there in their level of participation. So again, not a very good thing. Maybe the reason why for older people you see them less likely to participate is because they have accumulated enough wealth to basically, choose to retire, and we'll see some data about that in a little bit. But overall, I really wish we could see more people be willing to be in the labor market. I wanted to say one more thing about the unemployment rate. So while again 4.2% looks very good, it turns out that about 27% of people who are unemployed are long-term unemployed. And research has shown that the longer you are unemployed, the harder it is for you to find a good match in the labor market. Your human capital gets depleted, diminished. And so it's not good to see such a high fraction of those unemployed be long-term unemployed. Now, there is a little bit of good news about the labor market that's coming from the JOLTS report that came out a couple of days ago. The number of job openings is around 7.6 million as of May. It's unchanged relative to the previous month. There are 7.1 million unemployed workers as of today. So there's more than one job per unemployed worker who's looking for a job. So that's good. But if you look at, for example, the rate of quits, which is 1.9%, that rate has been declining in the past several months. And generally speaking, in normal times, the quits rate is about 2.3%. This rate of 1.9% for quits is below that. And it just tells you that people are not quite eager to leave their jobs because of some other opportunity, right? And it speaks to what a lot of us have felt, that it's, people are stuck in their current jobs. There may be job openings out there, which the JOLTS numbers say there are 7.6 million jobs, but they're not the kinds of jobs that people are able to take on, to jump to, or willing to jump to. So there is maybe a mismatch between what the employers are asking for when they post these jobs and what currently employed individuals have to offer or are willing to accept for employment. So there's some mismatch going on, I think, in the labor market in terms of job openings and unemployed people. So while again, we've seen in terms of the job openings per person an improvement over time in the recent few months, we're nowhere near what we were seeing, in a few years after COVID, or even in the sort of normal times before COVID hit. At that point, the rate of job openings per unemployed worker that rate was about 1.2. So it'd be nice to get to that, but also to have a high rate of quits, right? To see that there's dynamism, that people are actually able to move into these newly posted jobs, that they have the skills or again the interest in those types of jobs. So if you look at the JOLTS numbers, they would tell you, well, there's some resiliency in the labor market. At least firms are willing to hire, they're posting jobs. So in that sense, there's some good news. The rate of GDP growth in real terms, at least in Q1, was decent, was 2.1% annualized growth. If you think about forecasts for Q2, they're not that bad. The New York Fed nowcast is about 2.7%. Atlanta Fed is 1.2%. So we're still forecasting positive economic growth. The numbers that we're seeing in the US are definitely better than what we see in other countries. The world, as you know, has seen a lot of geopolitical instability. At home, we've had a lot of uncertainty in terms of policy, from tariff to other things. So it's remarkable, actually, that even in spite of all of this uncertainty globally and at home, that we did see more than 2% real GDP growth in Q1, and we're still forecasting positive GDP growth for the rest of the years. Now, part of why we saw this decent rate of real GDP growth in Q1 is because of the American consumer. The American consumer has not disappointed quite yet. People kept spending. If you look at this picture, it tells you in real terms the annual percent change in spending overall. This is the blue line, and then in terms of spending on goods, this would be given by the orange data series. And so we see that throughout 2026, Americans in real terms have been spending at a decent pace. In real terms, definitely. Almost without exception, we see an increase in spending. Now, how did it happen? Did people earn all of a sudden a lot more in real terms than the rate of growth of prices? And the answer again is actually no. We saw some data earlier about the rate of growth of wages, not super high relative to the rate of inflation. And in fact, in this picture here, you see it much more clearly that during 2025 and also through 2026 up until now, the rate at which people were spending, which is the blue line, was definitely above the rate at which their incomes were increasing. Okay, so the rate of spending was higher than the growth rate of income. Now, how can this happen? Well, it happens if people are dipping into their savings, right? And I'll show you data in a couple of minutes about that. Basically, the personal savings rate has been taking a hit. It's at a really low level right now, and it's been declining. So the American consumer has pushed economic growth to be quite good in Q1, but there is a cost, right, to that. They've been depleting their savings, and maybe again, this is why in those surveys of consumer attitude, consumer sentiment, people are quite pessimistic. Spending more in real terms does not mean that you are better off as a household. It doesn't mean that your financial or economic well-being is better now than it was before, just because in real terms you're spending more money. Again, we'll come back to this in a little bit. So uncertainty, as I said earlier, the global level and local level, quite high, but there's been some improvement. So you can see here, early in 25, of course, it was high uncertainty at home because of tariffs. In 2026, early 2026, uncertainty spiked again because of the war in Iran and gas price related concerns. We see that this index of economic policy uncertainty is now lower, has been declining in the past couple of months, but it's still relatively high. You want it to be down here around 100, not around 200. So there's still uncertainty, which is really not helping with firms being willing to hire, whether they're large firms or small businesses. Uncertainty is still relatively high for everybody, and so that's going to prevent making huge investments and hiring a lot of people. Now, again, so you see in this presentation, I'm sort of telling you good news and bad news. It's complicated. A little bit of bad news again is that the rate of inflation, even though if you look at the very, very recent data, maybe we're seeing a drop in that. It's not been close to 2% in 2026. It's not been anywhere close to the Fed's target. It's actually at 3.4% in the past couple of months. That's where it's been. In February, it was at 3%. So again, in the last maybe week or two, the numbers might look different. We don't have the final figures for that, so that's why I'm relying on the data for up to last month. So inflation is not looking very good. So the question is, what will the Fed do, right? Do they try to increase interest rates to help with inflation, or should they think about the labor market? And if you looked at what the market was predicting as of yesterday for what the Fed might do, as of yesterday, the market said, listen, the next meeting, which will be at the end of July, probably they'll leave the rate unchanged. Right now, the target is between 3.5 and 3.7%. But then a year down the road, if you looked at the distribution of probabilities assigned to different bins of the target rate, the bin between 4 and 4.25% actually was getting the highest probability. So the market was seeing easily two a quarter point increases in the target rate up until next June. This morning, right after this report came, these numbers went down. So the most likely outcome, and as far as the market is able to guess, for June 2027 is to have a target rate that's about 1/4 point higher than today. So we're still expecting a little bit of an increase, but not quite as high as yesterday, because I think this report is saying the labor market is not quite in as good of a state as we all thought, based on data from the previous couple of months. Those revisions and the payroll numbers that were downward revisions, 74,000 plus today's lower number, that should concern the Fed. So it's going to make their job a little trickier now, balancing concerns for inflation and for the labor market. So a few more things about the consumer, and then we'll take some questions. So the personal savings rate, as I said earlier, has been declining. It was 4.5% in the middle of 2025, and now it's only 3%. So people have been saving less, and that's how you can explain the sustained increase in consumption in real terms in spite of wages not keeping up with inflation. That's not good, and you can probably see this reflected in what consumers say in confidence surveys. Whether you look at the Conference Board data or the University of Michigan data, it doesn't really look that good for 2026 relative to what we saw in previous years. In Michigan, it's looking particularly bad, even though we just a few days ago we saw a little uptick in consumer sentiment in Michigan. So and it probably reflects the fact that gas prices have stopped, increasing, or maybe even showed a bit of a decline in the past few weeks. Michigan, when they ask consumers about their attitudes, a lot of the questions are really about prices, and so if prices get better, you should see the index go up, and then we've seen that in the last reading. But overall, people are relatively pessimistic. Now, there's a big drop that you see here in around 2025 for Michigan. That's actually a measurement issue. They've changed the way they ask people to respond to the survey. It used to be, face to face with an interviewer, or over the phone with an interviewer. So you have a conversation with a person. These days they shifted to online survey administration. So it changed things a little bit, but it doesn't explain what happened in 2026, this trend. This is done with data collected just on online, and you definitely have seen people becoming more pessimistic in 2026, with the exception of this little increase in the very last month. So people are pretty pessimistic. Inflation-wise, the good thing, they're now getting a little bit less worried about inflation as a few months ago. So that anchoring expectations closer to the target rate of 2% is good. They're not still at 2, but it's better than before. So again, this should help the Fed not at least worry that there are these expectations about inflation among households that are spiraling out of control. That's a good thing for the Fed. The balance sheet of households is not bad. Everybody is showing some increase in real term that's positive over the past year in terms of their net wealth. Much more so, of course, for the top 1% of households who own assets like homes and and equities. But even people at the bottom are showing real increase in net worth year on year. So that's good. At least the balance sheets are fine. Home prices are recovering after the slight dip from last year. So if you're a homeowner, you should get a little bit of a wealth effect from this. You should feel more comfortable now than maybe towards the end of last year. So again, the balance sheet looks pretty good. But if you look at how good it looks like across people of different ages, there's a very large age difference. So if you are a young person under 40 years of age, look at your wealth level in real terms, and you see that in the past several years, there's pretty clear stagnation. Whereas if you are an older person, 55 to 69 or 70 or older, you've had in the past few years a very sharp rise in your real wealth. It is flattening a little bit now. relative to the end of last year. And again, that reflects something about home prices. It also reflects recent maybe trends in equities. But basically, older people have had their balance sheets have gotten much better in the past several years compared to those of younger individuals. And that explains the last thing that I showed today before we stop for questions, which is that since 2025, since January, we've seen a flip in consumer attitudes by age. In the past, if you look at this blue line, it tells you the optimism of younger people, those 18 to 34. In the past, this blue line was always above the red line, people who are 55 and over. So younger people were more optimistic about the economy than older people up until early last year. And since then, this blue line is below or at best equal to the red line. But this is unusual, right? We have young people these days, younger people who they used to be the ones carrying the American optimism forward, and they're not doing that as much as before, and that is a concern. And it probably again relates to the fact that if you look at their balance sheets, they haven't seen a large increase in real wealth, and it's also very hard for them if you're a young person now to buy homes, for instance, because of that huge jump in home prices. So I'm going to wrap up with this slide. I think here the main takeaways: the labor market is showing these conflicting signals. Real GDP growth is fine, but if you look at the labor force participation rates, that's not very good. So there are concerns about that. Inflation is not good either. The Fed should be concerned about that. You might see an increase in the fall, probably around September. The market assesses some probability that you'll see that a 1/4 point increase. Consumer pessimism actually may be quite warranted. This may not be a Vibecession in the sense that consumers are getting it wrong. Their pessimism can reflect the fact that they've had a lower savings rate because of having to pay higher prices and not getting higher wages in real terms. Real estate markets have been difficult in terms of both valuations and liquidity, which makes a lot of people unable to either buy a new home or actually get out of one. And also the labor market is giving people fewer outside options. Remember the rate of quits is relatively low. People are not seeing other places they could jump to. So again, this Vibecession idea is not really a puzzle. I think just looking at real consumption growth, saying Americans have spent more in real terms than in the past few months, this is not an indication that they're feeling better in terms of their financial well-being, right? Consumption growth can come at the cost of a weaker safety net because of the depletion of savings for a rainy day, or it can come at the cost of foregoing important investments, right? Some people might just give up hoping that they will ever be able to buy a home, and they'll just spend now. They'll consume now instead of investing for the longer term through, for instance, buying a durable asset like a home. And this is not good because research in the past, including some of the work that I've done, has shown that the longer people are exposed to continuous negative shocks, whether they're about the labor market or about asset markets, it basically leads to people being too pessimistic. And if they're too pessimistic, if they see the macroeconomy through this lens of a glass is half empty rather than a glass is half full, they're not going to make the right types of investments in their human capital or in equities. And so when they don't make the right investments, it's actually is going to prolong the times of difficult economic conditions. So my hope is that we're going to start to see more and more good news. We're going to see more. Hopefully, we'll also see a drop in this uncertainty about policy or global affairs, so that firms and people can just go ahead and make the right types of investments for themselves. That's all I got for today.
And that was a lot. Thank you very much, Cami. And Cami, you can hear me, can't you?
I can.
Okay, that's good. Somebody said I was having mic problems in the intro, so I've switched input devices, and we'll go forward with that. So it's time for questions. If you have a question, please submit it using the Q&A function at the bottom of your screen. You might find that under the More button with the 3 dots on it. If you're with the media, please give us your organization along there so we'll know to prioritize the question. And if you're with us by phone and have a question, you can email it to me at rob_knapp@Kenan-Flagler.com. We're right at 9:30, maybe a little past, but we're certainly going to try and work in a couple of questions. If you have them, just get them to us quickly, please. So, Cami, this has come up before, the talking about the 2% goal for inflation that the Fed has. There's some talk from time to time. Is that number ever going to move? Is there going to be a decision? Now we have a new regime at the Fed. Does that make sense at this point, or is 2% where we need to be?
Well, I think economists will be arguing a lot as to whether or not they need to change this 2% number. This 2% number is given by many, many assumptions, and you can argue about every single one of the assumptions. And honestly, it's not a magical number that works, that really is the answer to the question no matter what. So I think we will see arguments about this. I doubt that we will see a change in this target, just because we haven't had a better one for a long time, and it's ingrained in the minds of most economists. It is difficult to change priors unless you have a really, really good reason. If you have a model that says, absolutely, this is the reason why we're changing from this old target. But nobody has it, just because it's an incredibly complicated problem to solve, to figure out what is the optimal rate of inflation that you're willing to allow. So I don't expect to see really much of a change, because nobody will have this incredibly convincing argument for it.
Okay, that's a good reason. You talked a little bit about the mismatch in the labor market, where and that's something we talk about a lot at the Kenan Institute in terms of the skills gap, where the skills of workers maybe not have kept up with the change in the demand from employers. Is that mainly what we're seeing, you think, in that gap number, or are there other things that contribute to that?
I mean, it's hard to tell you, okay, this percent of the puzzle is resolved by the skills gap, but the skills gap is definitely there, right? And you can easily see this if you look at young workers. So those that are recent college graduates, they have these days an unusually high rate of unemployment. They have a hard time finding a job. And, that tells you that they don't have the right skills for what firms are looking for. And that is a problem. It tells us that, educational institutions have to rethink what they teach young people, so that they're in demand for firms. Now, the world is changing dramatically also. And so it could be that the skills are in demand right now are not going to be in demand, next time or a year from now. So then the question becomes, how do we train people after they graduate? Like, how do they get trained on the job, or what sort of upskilling efforts should the country or should each state invest in to make sure that people can continuously upskill to meet demands from employers? I think this idea of basically continually educating yourself and upskilling, this is a relatively new thing for the United States, and honestly for the world in general. But I think this is the reality of where we are, that the pace of change of the needed skills is much higher than before. And so we have to have some programs that allow people to upskill continuously throughout their lifetime. So lifelong learning. I'm pushing for lifelong learning. Now, I'm an educator, so maybe it's a self-serving bias here.
Nope, that's fine. That's our motto here, so we'll stick with that. Camelia Kuhnen, thank you very much for your analysis this morning and your answers. We appreciate it. Thank you to everybody who is out there attending today. We appreciate it. It's hot outside, so it's a good day to stay inside and listen to a briefing. So for those of you in the media, if you'd like to continue the conversation, you can email me, rob_knapp@kenan-flagler.unc.edu. we can set up an appointment for you to talk to Cami or any of the rest of our experts here about whatever you're working on. For those of other attendees, we hope you'll visit our website at kenaninstitute.unc.edu. I told you last time, we've redone the website, so if you haven't gotten past, please take a look. We've got new things going on. I know it's the summer, things slow down a little, but we're continuing to put new things on there. And coming up fairly soon, we will have an update on our American Growth Project projected growth numbers for the top extended metropolitan areas around the country. That would be interesting. I'll probably remind you of that when we come back again for our August briefing. So, speaking of that August briefing, I believe it's August 7th. We're back on a Friday then. So, we hope to see you then. But until now, thanks for coming today and enjoy the rest of your Thursday.
Bye, everybody. Happy 4th.